Hello everyone here. Hello everyone. It's Darren at Leviathan here with your afternoon update of what's going on in the markets. Well, bit of a mess today. I guess the summit didn't go as well as thought. There were no deals that we have heard of, just a bunch of warnings. And so we see once again the oil market climbing, currently up $4, about 50 cents short of the high today. We are seeing a huge pullback though in fixed income. 10-year blew through the 4.5 base yield. Now currently yielding 4.59. 10-year futures down nearly a point. Just 2 ticks off their low at 109.06. And we are now at basically nearly a 90% chance of a hike by the end of the year, which, yeah, that's a bit nuts. Now, let's have a look at any other news headlines that I see coming across the market. The one thing I would say about the rates, if they're going to start, they're probably going to do more than one, and we're going to go on that in a minute. Obviously, there's also the news coming out of the UK, the latest being that Starmer will not seek to block Andy Burnham from becoming Labour candidate in Wakefield, which could pave a return to Parliament and a leadership bid. So we'll see how that goes. Apparently, we have informed Tel Aviv of the possibility that Trump might order strikes inside Iran. And earlier, Axios reported that they're discussing options for military escalation to break the deadlock. Fez Hamak today said independence is critical to an effective central bank, repeating what a couple of the Fed reps governors have been saying over the last 2 days. As to whether or not that happens remains to be seen. So anyway, going back to rates. So one thing kind of surprises me is if we go have a look at, I wanted to look to price in what would happen if we priced in 2 hikes for year end. That, given the kind of movement we've been having, is not an unreasonable level. I think a lot of banks are still coming to terms with the fact that the next move may be higher. But if we at least price that in, is there anything that we can do in the markets? And yes, there is. If you want to assume that the market could potentially price in more than one rate hike by the end of the year, there's still some good trades to be done in short end. Still have not missed the boat. If that does come about, we're looking to target around the 95.86 area. That would be the midpoint, give or take. And this trade here is a good one. The ratio put fly, 95 or 56, 58, 60 as we call it here. Put fly ratio 2/3/1. This trade here, we'll have a look at that in more detail. So relatively speaking, it's actually really cheap. It's in its second percentile when going back at least 2 years. So that is basically looking at this far out the money put fly. We've been in a cutting cycle for a while to not even consider this, but still. So if we really are changing stance and going for a cycle that would involve more than one hike, then this is a very cheap buy. You know, at the moment you could buy this condor for a tick and a half. I'm going to hide this so we can have a look at the heat map here. Actually, we'll go back to here. Let's have a look at a detailed report here. And you can just see here, there's a lot less risk involved. These are different low, high, and unchanged volatility. So yeah, like that trade 2x3. And if you want something more plain vanilla, then this regular fly doesn't give you as good a return. But again, if you can get in at 1.5, that is the 56 plus 58, 60 plus put fly. Again at 1.5 ticks. Similar value. Again, also in its very low percentile, not quite as cheap as the other one, but not bad. And you know what your exposure is here, and that's it. And there would be your sweet spot. And it kind of does monetize fairly well on the shorter term, which is great. When you look at it, say you could easily double your money on a short-term move on this. So go down any more from here, and it could easily be a double your money trade. And as we look back here, potentially on any of these, either an 800% return or a 770% return, depending on which one you do. Great returns on either, though. So those are the two. We're going to have a look at some downside trades in S&P on Monday. Actually, you know what? Sorry, let's run one now, see what we have. Why not? We can have a look at this one. This one we ran earlier on, but let's refresh it and see if things have changed. So this one would be targeting 6,500 by September expiration. We should run that one through and see what happens. I mean, just given the price action, I don't know myself. I'm not overly convinced, but purely because, not that I don't think it should be there, it's just that the over-exuberance in AI has seen this go, nuclear, the stock market. And the fact that it's only down 50 ticks now, even after 50 points rather, the S&P is still sitting in at a nice comfortable 74.50, makes me wonder what the underlying bid to this fixed income market, to this AI market actually is. So is there any stuff to do? Yeah, there is. Here, these are ratio put trees. I don't like to suggest them for you because as an open-ended downside, this ratio put condor is not too bad. But let's go vanilla. And basically for these markets, it's just saying, I'll just buy the puts for September. They're the cheapest thing to do. Take a punt on the 6,800 put. You know, it's got... The system will pull out the best risk-reward trade based on your idea. And so in this instance, it just, it didn't do anything complicated. It just said, this is the cheapest one you could get. It's still quite expensive. But, that's a good indication of where things are. Here's his skew. Let's just have a look at. Right, so you can see here, this is the blue line here was the settle 2 months ago. So that's probably in the middle of it. So hang on, let me just change that to even further out. Let's go 6 months ago. There you can see that's actually volatility surprisingly a bit lower than what it was. But the skew's still firm to the downside. If we look at the ranking, it looks like they're relatively speaking, some of the puts are fairly cheap relative to ATS. So might be worth having a look at some stuff there. Try and look at, say, 10 delta put. 10 delta puts relative to at the monies are fairly low. So that implies we're not convinced it's going down, but it's whipping around in the middle. So vol short-term bid and wings offered. That would go along with the fact that the strangles are on their lower end of vol when they're normally a lot higher relative to at the monies. So basically, just buy some downside puts. That's why I picked it. Anyway, as I always say, better be lucky than be good. So good luck to you all and have a wonderful weekend.